In the world of investing, stock dividends represent a significant aspect of the stock market and a key strategy for wealth accumulation. For beginners, understanding the intricacies of stock dividends can seem daunting. However, grasping the fundamentals can set the stage for successful long-term investing. Whether you're a novice investor or looking to refine your knowledge, the foundational knowledge of stock dividends can help you generate significant passive income. In this video, we'll discuss everything you need to know about stock dividends in 2024. But before that, subscribe to our channel and hit the bell icon for regular updates. Now let's get started. Understanding stock dividends. Stock dividends are payments made by a corporation to its shareholders, usually in the form of additional shares of stock. Unlike cash dividends, which are paid out in cash, stock dividends reward shareholders with more shares. This approach helps companies preserve cash while still providing a return to investors. Stock dividends are particularly attractive to investors seeking a steady income stream and those looking to reinvest their earnings to compound their returns over time. Stock dividends are generally declared on a per-share basis, meaning shareholders receive a certain number of additional shares for each share they already own. The total value of the dividend is determined by the company's board of directors and is often announced during earnings reports. The value of the stock dividend is proportional to the shareholders' current holdings. For example, a company might declare a 5% stock dividend, meaning shareholders receive 5 additional shares for every 100 shares they own. This process increases the total number of shares outstanding, which can dilute the value of each share, but it also increases the ownership stake of shareholders. Types of stock dividends. There are several types of stock dividends, each with its characteristics and implications for investors. Understanding these types is crucial for making informed investment decisions. Cash dividends are the most common type of dividend, paid out in cash to shareholders. The amount is usually expressed as a fixed dollar amount per share. However, receiving cash dividends also means shareholders have to pay taxes on the income. Stock dividends, on the other hand, are issued in the form of additional shares of the company's stock. Instead of receiving cash, shareholders receive more shares and they also offer a tax advantage. Special dividends are one-time payments made by a company, often following an exceptionally profitable period or a specific financial event. Preferred dividends are dividends paid to preferred shareholders, often at a fixed rate, and must be paid out before any dividends are issued to common shareholders. Preferred shares are a type of hybrid security that has characteristics of both stocks and bonds. How stock dividends are declared. Declaring stock dividends requires various stages to ensure fair distribution. The board of directors must approve the dividend first. The board must assess the company's financial performance, cash flow, and prospects. The declaration date follows the board's approval of the dividend. On this day, the board announces the dividend. Ex-dividend dates are also important in dividend processing. An investor must own the stock by this date to receive the dividend 2 days before the record date. On the record date, the corporation checks its records to determine dividend-eligible stockholders. Only shareholders recorded on the company's books at the record date will receive the dividend. Finally, stockholders receive the dividend on the payout day. Shareholders receive cash or shares on this date. Understanding dividend yield. The dividend yield ratio compares a company's annual dividend payout to its stock price. For example, if a company pays annual dividends of $2 per share and its current stock price is $40, the dividend yield will be 5%. The dividend yield shows investors the prospective income from their investment compared to its market price. An inexpensive stock with a greater dividend yield may have a larger income return than its price. High yields due to falling stock prices can be risky. A low dividend yield may signal that a stock is expensive or that the company is reinvesting more in growth than payouts. Dividend yield helps investors compare stock income prospects. One firm with a 4% dividend yield has a better income return than another with 2%. Dividend yield should also be considered with the company's financial health and growth prospects. Several factors influence a company's dividend policy, which can help investors make informed investment decisions. A company's dividend policy is heavily influenced by profitability. Profitable corporations can pay greater dividends because they have more earnings to distribute. Even profitable corporations may preserve earnings to reinvest rather than pay dividends. Another major influence on dividend policy is cash flow. Strong, steady cash flows allow companies to pay dividends because they have the funds. Companies with fluctuating or weak cash flows may pay reduced dividends or not at all. Growth opportunities can also influence a company's dividend policy. Companies with high growth potential may reinvest money instead of paying dividends. This strategy may increase long-term capital appreciation for shareholders, but diminish dividend income. Debt levels also affect dividend policy. High-debt companies may pay lower dividends to service debt. High debt levels can signal financial danger, affecting the company's dividends. Taxes might affect a company's dividend policy. Taxes can affect how corporations allocate earnings to shareholders. If dividends are taxed more than capital gains, corporations may retain earnings and reinvest instead of paying dividends. Benefits of stock dividends. Stock dividends offer several advantages to both companies and investors. A steady income is one of the primary benefits of investing in dividend-paying stocks. This income can be used to cover living expenses, reinvest in other investments, or save for future goals. While receiving dividends, investors can also benefit from the potential appreciation in the stock's price. This dual benefit of income and capital appreciation can lead to higher total returns over the long term. Dividend reinvestment and tax advantages are also key benefits of investing in dividend-paying stocks. Many companies offer dividend reinvestment plans, DRIPs, allowing shareholders to reinvest their dividends to purchase additional shares, often at a discount and without commission fees. Qualified dividends are often taxed at a lower rate than ordinary income. This lower tax rate can increase the after-tax return on investment. Risks associated with stock dividends. While stock dividends offer many benefits, they are not without risks. Dividend cuts are one of the primary risks associated with dividend investing. Companies may reduce or eliminate dividends if they experience financial difficulties. This can lead to a decrease in income for investors. Market volatility is another key risk associated with dividend investing. Stock prices can fluctuate, affecting the value of dividend-paying stocks. Investors should be prepared for potential market volatility. Inflation risk and opportunity cost are important considerations for dividend investors. Inflation can erode the purchasing power of dividend income over time. Investors should consider stocks with a history of increasing dividends to combat inflation. Investing in dividend stocks might result in missed opportunities in other high-growth investments. Investors should consider their overall investment strategy and risk tolerance. Dividends are subject to taxation, and understanding the tax implications is crucial for investors. There are two main types of dividends for tax purposes. Qualified dividends are taxed at the lower long-term capital gains tax rate, which can range from 0% to 20% depending on the investor's income. To qualify for this lower tax rate, the dividends must be paid by a United States corporation or a qualified foreign corporation, and the investor must meet certain holding period requirements. Ordinary dividends, on the other hand, are taxed at the investor's regular income tax rate. This rate can be significantly higher than the long-term capital gains tax rate, reducing the after-tax return on investment. Investors should be aware of the tax treatment of their dividend income and consider strategies to minimize their tax liability. How to choose dividend stocks. Choosing the right dividend stocks is crucial for building a successful dividend-focused portfolio. Investors should consider several factors when selecting dividend stocks. Dividend yield and growth potential are important factors to consider when choosing dividend stocks. Look for companies with a strong history of paying and increasing dividends. The payout ratio is another key metric to consider. This ratio measures the percentage of earnings paid out as dividends. A lower payout ratio suggests that the company has ample room to maintain or increase dividends. Company stability and market position are also important factors to consider. Look for companies with a strong track record of stable earnings and consistent dividend payments. Blue-chip companies are often reliable dividend payers. Building a well-balanced dividend portfolio involves careful planning and diversification. Diversification is crucial for reducing risk in a dividend portfolio. Invest in dividend-paying stocks across various sectors to reduce exposure to sector-specific risks. A diversified portfolio can provide more stable returns. Reinvestment is another key strategy for building a dividend portfolio. Take advantage of DRIPs to reinvest dividends and benefit from compounding. Reinvesting dividends can significantly boost the overall return on investment. Also, regularly review your portfolio to ensure it aligns with your financial goals and risk tolerance. Make adjustments as needed to maintain a balanced and diversified portfolio. Balancing growth and income is another important consideration. Include a mix of high-yield stocks and those with strong growth potential to balance income and capital appreciation. This approach can provide a steady income stream while also allowing for capital growth over time. Subscribe and hit the bell icon for more updates. Thanks for watching.